Joining me now with more is Andy Walden, Vice President of Research and Analysis at Intercontinental Exchange. Andy, good morning.
Good morning, Kristen.
It's great to have you on the show as we start what will be a very busy week with housing in focus, as I mentioned. And I know ICE recently released its September Home Price Index. What are your biggest takeaways from the September housing market data?
Yeah, and I think there's a number of different things that kind of jump out when you look at September data out there. One is that the housing market continues to cool. The annual home price growth rate fell below 3% for the first time since July of 2023. And so you're starting to see the heat come out of the housing market. And that's really true across the country. We've got the lowest ceiling that we've had in 2 years out there as well. St. Louis saw just over 6% annual home price growth, which is the lowest high end of the market, if you will, that we've seen in a couple of years. The other thing that really catches my eye when you start to look at housing market data over the last 30 days, inventory continues to improve. That's the 8th consecutive month we've seen a little bit more inventory coming out there in the market. And sellers peeked their head out a little bit in September as well. We were still seeing a deficit in terms of the number of homes coming on the market in the month of September, but the shallowest deficit that we've seen in 2 years. And so that'll be a trend that we'll be watching closely over the tail end of this year and into 2025.
I think that inventory note that you mentioned just a few moments ago is certainly a positive for potential buyers out there, Andy. We know higher home prices do positively impact existing homeowners across the country. How much equity are they sitting on at the moment?
Yeah, we're actually seeing record levels of equity out there for homeowners. A little over 17 trillion held by mortgage holders across the U.S., a little over 11 trillion of what we call tappable or lendable equity that could be borrowed against while still maintaining a pretty healthy 20% equity stake in their homes. And so the potential for some more lending and borrowing activity out there from a home equity standpoint, you're also seeing, along with that, very lightly leveraged homeowners as well. If you look at total first and second lien mortgage debt, it's equivalent to about 45% of underlying home values. That's traditionally over the last 20 years been closer to 58%. So again, pretty lightly leveraged, heavily equity in the housing market.
In this environment, does the data show that homeowners are borrowing against their equity?
Yeah, I think the answer to that is yes and no. When you look at the third quarter of this year, you saw $48 billion extracted from the market via first lien cash out refinance activity, via second lien home equity line of credit activity. All three of those, total equity withdrawals, home equity line of credit withdrawals, first lien cash out refinance withdrawals, all three of those hit 2-year highs. They were slightly up from the second quarter of this year. And so you are seeing more equity withdrawn than we've seen over the last couple of years out there in the market. On the opposite side of that coin, borrowers are still being relatively conservative in terms of the way and how much equity that they're withdrawing from their homes. Over the last 2.5 years, we've seen about $500 billion withdrawn from the market in terms of home equity withdrawals. We've seen another $500 billion that has not been withdrawn and flowed back through the broader economy. So folks withdrawing equity at about half the rate that they traditionally would. Now that could change over the next 12 months depending on where the Fed goes with rates.
Yeah, let's talk more about that because I do believe that could be the biggest market-moving event this week, despite a full plate certainly ahead of us here at the stock exchange. And so with traders betting that the Fed will cut rates, Andy, by 1/4 percentage point on Thursday, how do these declining rates impact the cost to withdraw home equity?
Yeah, and when you look at mortgage rates themselves, that Fed rate reduction later this week is largely already baked in. When you look at mortgage rate futures, Fed action largely already baked in there as well. The area that we could see a much more direct impact is on second lien home equity line of credit offerings, right? The Fed rates tend to pretty directly impact the prime rate. HELOCs are set on a spread to prime. And so when the Fed moves interest rates by 1/4%, like you mentioned, they're expected to later this week, that directly flows through the market in terms of lower home equity interest rate offerings, right? And that could significantly impact the cost to borrow against home equity in the U.S. We look over the last 20 years, right? And we look at this in practical matters. To borrow $50,000 in home equity, the typical monthly payment on a home equity line of credit is right around $200 a month, slightly above that, to borrow $50,000 in equity. As the Fed has put upward pressure on rates, that's gotten over $400 per month to borrow $50,000 in equity earlier this year. Given the recent Fed rate cuts we've seen, given the expectation for later this week for another cut, and cuts throughout 2025, home equity interest rates could go from over 9.5% earlier this year down into the mid to low 7% range as we get towards the tail end of 2025. That could take that $400 a month to borrow $50,000 in equity down to $300 a month and make it more attractive and more affordable for folks to start to borrow against some of the equity in their home. And you could see some of that activity pick up as we move towards the middle stages of next year.
Andy, I do want to quickly hit on the jobs report, of course, out on Friday, revealing a negative impact from Hurricanes Milton and Helene last month, with just 12,000 jobs added. How have we seen those weather events impact housing?
It had a significant impact this year. If you just look at the number of mortgaged homes that have been in the path of these three storms, Beryl, Helene, Milton, you're talking 6.1 million mortgaged residential properties. That's over 10% of mortgaged homes in the U.S. that have been in the direct path of a storm, according to our ICE climate data. And so you're seeing some significant impacts. I think that could mean two different things for the market. One is when you look at mortgage payment activity. We're already seeing in Houston and surrounding areas following Hurricane Beryl, there are about 13,000 mortgage holders that have been financially impacted to the point where they're struggling to make their mortgage payment. You're already starting to see some of that same data come out from Hurricane Helene and Hurricane Milton as well. 3,500 folks already in September, even though that storm came in at the end of the month. 3,500 folks struggled to make their September mortgage payment right around North Carolina, South Carolina, and down through Florida. And the larger impacts, if you look at our daily performance data, are expected to come in October and November, given the timing of those storms. And so I certainly think there's financial loss in folks struggling to make mortgage payments that need help. A few weeks ago, we had also talked about property insurance costs out there across the U.S. and how the average property insurance payment is up over 50% over the last 4.5 years. I think it's fair to expect that in some of these hurricane hit areas and in the higher risk areas, that trend is likely to continue here over the next couple of years, which are going to continue to face pressure on those payments.
Andy, I'm glad we have you as our in-house expert to talk all things housing and, of course, increasingly the intersection of climate as well. That's Andy Walden, Vice President of Research and Analysis at Intercontinental Exchange.